my secrets, nothing more. I checked the drawers, I checked the spikes, left me hanging in my Nikes. Last night we tore up the town, now my wallet's not around. Call the cops or play it smooth, pay my debts and start anew. Hey, hey, where'd it go? My cash, my cars, my flow. Don't you know what's gone? Now I'm broke from dusk till dawn. Dancing lights and screaming bass, drinks were flowing in that place. Left a tip but lost my grip, now my wallet's gonna slip.
In a world where financial advice is as blurry as a wild night of cheap Jell-O shots, clear your head and your monetary halitosis with the About That Wallet Show hosted by Anthony Weaver. Leave those Jell-O shots for the amateurs and learn to indulge in the top shelf bottles, baby. Now, here's your host, Anthony Weaver.
Oh, hey, how you doing? This is your host. I've actually, if you guys haven't noticed, today is July 24th, Friday Eve, 8 o'clock Eastern Standard Time. I just want to welcome you all to the show where we actually help the financial strengthening of the sandwich generation by one interview at a time, and so that you have that ability to build that confidence through competence. And how we build competence is by education. And by education, this is where I come in to try to provide you with the information that's necessary so that you can be successful in whatever you need. So today, we have a question that came through from one of the listeners in New Orleans. I would say Stephanie mentioned, like, hey, one of my children just received about $10,000 from their uncle who passed away. What should I do with it? And I don't know what to do with my taxes and so forth. So that got me thinking there's so many different ways that a child could actually utilize the $10,000 and what the parent can do for the child that's under the age of 18. And one of the things that they can do is something called the UGMA or the UTMA, which is ultimately considered a gift tax. Now, keep in mind, this is for educational purposes only, and that I am going to be sharing all this lovely information so that you will have the understanding of what it is. So with that being said, we'll go ahead on and share the screen. The reason why I like sharing the screen is because y'all can say, like, hey, Anthony, you weren't lying about that. We know what that is. But also, we got to think about the gift tax. Think about, when did it start? Why did it start? Because somebody had to come up with the idea, right? Like, why would they just come out the blue like, gift tax? I want to give somebody this money, but why? And who would actually think about giving somebody some money? So let's think about it. I'm going to take you all the way back in the time. Who was that? That Black Street to say that? So I'll go ahead on and read this. So just keep in mind, if y'all leave a message underneath, go ahead on and post it. So I'm going to just read directly from the website. This is I got to figure out which one of these I'm sharing, because obviously it showed up on the screen. I don't know where it said, because I have a lot of screens open right now and I wanted to make sure I have everything. Here we go. So we got to think about the gift tax. I was like figuring out, what the heck is the gift tax? Where did it come from? Why is it important? And those are things I want to help. I want you to kind of listen to my thought process in this journey. And if you have any questions along the way, please throw it in there. So let's look at it. So there's an analysis of the 1998 gift tax panel study. So we have to remember that the United States is still new when it comes to a lot of things. And if you guys are wondering what I'm drinking, this is a blue margarita mix with 100% agave. And so I could go ahead on and share it with you all. This is what I'm drinking for the day. All right. It's a great mix. Got to go through today. It goes with my dinner because it's dinner time. All right. I know it's a side step. Let's move forward. Okay. Back to the reality. What we got? I don't like that one. Okay. So the first federal gift tax was introduced to the Revenue Act of 1924. Congress imposed the 1924 tax after it realized that wealthy Americans could avoid the estate tax introduced in the 1916 by transferring wealth during their lifetimes, called the inter revos giving. Tax-free inter revos, vivos, gives effectively negated the estate tax capacity to redistribute the wealth accumulated by the large estates and removed a source of revenue for the federal government's reach. So this is by Johnson and Euler in 1998. This is what they discovered. The first gift tax was short-lived due to the strong opposition against the estate and gift tax during the 1920s. Congress repealed the gift tax with the Revenue Act of 1926. That's Zaritsky and Ripley of 1984, reintroduced in the Revenue Act of 1932 when the need for the finance federal spending during the Great Depression outweighed the opposition of the gift taxation. The 1932 gift tax allowed a grantor to transfer $50,000 during his or her life and allowed 5,000 annual exclusions per gift recipient or donee. The 1932 Act set gift tax rates at 3/4 of the estate tax rates, a level maintained until 1976 when Congress passed the tax reform on the TRA of the 1976 and created a uniform estate and gift tax framework that accused of a single graduate rate tax of the imposed both lifetime gift and testamentary, can't even say that word, disposition. The generation skip tax transfer tax was also introduced in the TRA in 1976. So think about it. What was really going on in 1932? So 1932 was also the Great Depression. So which means that they had to find a way to kind of make sure that people still had their wealth in a time of that depression. They was like, oh, cool, everybody's pulling their money out. How can we help the rich continue to stay rich and the poor continue to stay poor? This is how it's reading to me. Again, this is my personal view, not a reflection on everything else, but it just seems that way, that they just trying to find ways when things really get messy. They want to make sure that the rich are protected. So let's see here, continuing. During the years of the 1932, features such as marital deduction and rules on split gifts were introduced to the gift law, but predominant changes to the law were adjustments to the amount of the lifetime expectation, meaning the lifetime exemption and the annual exclusion. A gift is taxed under the law that is in effect during the year in which the gift is completed or given, according to the transfer tax law in effect for gifts completed in 1997. The focus of this paper, a grantor was required to file a federal tax return, Form 709, for transfers of property excess of $10,000 for donee. So this is interesting. So tax form 709, which I happen to have pulled up. Where's that? I know I had it pulled up recently. It's the IRS website. You gotta love it. Actually, they updated the form, so it's no longer the form 709. So now it's the form 8615. So you're talking about a gift to your child. So that we got a little bit of information about, how it was set up and back and forth as far as the parents were giving away money to gifts and stuff like that. So the gift tax can also pertain to you as an adult as well. But for right now, we're going to focus on the children. If we want to talk about the adults, I'm going to see if Angelina King from 718 tax services can come through to talk about that. But we can have a longer discussion about that another time. But for right now, we're going to talk about kids. So on this form, for those of you who actually received a gift for your child, and this is how you can do that because it's unearned income. So they said number 2 right here, just reading the form. If the child did not itemize deductions on Schedule A Form 1040 or Schedule A Form 1040 NR, enter 2,600. Otherwise, see the instructions. And I was like, where are the rest of my instructions? Because usually each form will have instructions. They don't have instructions. So we gotta do what we gotta do, okay? So we also have here, you gotta enter the tax return for the adult or the parent. So you gotta look at the parent form on 1040, line 16, minus all the alternatives and minus alternative minimum tax. Do not include any tax from form 4972 or form 8814, or any tax captured in the recapture of an education credit. If the parent files the form 2555, see the instructions if qualified dividends for the capital gain tax worksheet, Schedule D tax worksheet, or Schedule J form 1040 was used to figure out the tax. Click here. So they already breaking down everything that you need for your tax for your children. So then I was like, okay, now we understand that, at least the limitations on what it is and how to file it. What can we do if they are given that $10,000? So I was like, maybe a brokerage could possibly break down a little further, just kind of like a high level thing. You would think the IRS would do that for you, but no. So here we are. This brings us even closer to understand what the heck is a custodial account, right? Because you got the $10,000 and they was like, well, if you put it into a custodial account, because we talked about that with Lisa J. Stocks, as far as how we do custodial accounts. This is something that you can check out that episode and learn a little bit more about it. Hey, what's going on, Paula? Thank you for stopping by. Greatly appreciate it. So, we talking about the tax code right now. And what we have here is, what is a custodial account? So Schwab, I'm actually on Schwab's website right now just to kind of talk about it. Just about every broker has their own custodial account. So this is just one company. I just like the way how they had everything laid out. So that's the reason why I'm talking about them. So Schwab custodial account is a brokerage account that allows you to make a financial gift to a minor and help teach them about investing. It is set up and managed by an adult and turned over to the child when he or she reaches the age of majority. I'm sure to say majority, probably like 18 or so. Now, keep in mind that the adult has to just be age of 18 or older to actually create this account. So they can have a custodial account for that child. Now, for the tax year, we'll zoom in on here. Now, keep in mind the taxes change every year. So if your child is given 10,000 this year, they can get another 10,000 next year and continue on. But however, say if they're getting too much money because everybody want to kind of give. You got to keep this in mind. So for the tax year 2025, no gift tax incurred for the contributions up to 19,000 or 3,800, I mean 38,000 per couple for each beneficiary in a single year. Now, this is also a gray area when they say beneficiary. That means anybody that's a beneficiary of that gift that you're giving. So that means if you have 5 children and you have 19,000, for each beneficiary in a single year. So that means you can actually, if you have 5 children, and we're going to round this up. Well, we can't round up to 1,000, like round up to 20,000 because the taxes don't allow it. Well, let's just say 10,000, right? You giving 50,000 away to each of your children. So if you got 5 kids, you give away 50,000. Even if it's not your own child, because you gift it to another child, you can write that as a gift tax. So you do not get taxed on that particular gift that you've given away. So when you start looking at your taxes and your tax return, and you're like, why do I owe? Why do I owe so much? You can go back and say, like, I want to gift my child some dollars right quick. It can actually help lower your tax rate, which is actually pretty cool. And this is just me reading it. I'm not saying I'm suggesting it. This is for educational purposes only. And furthermore, they say for the year 2025, a child under 19 is considered a dependent at the end of the year, or a full-time college student under the age of 24. Ooh, so this means oh my gosh. This is another reason why it's important to send your children to school. Because you can gift them money. You can create a custodial account for them. They can manage their money at their 19 if they want to, but if they're considered a dependent, you can give them to them. And they further say the first $1,350 of a child's unearned income is tax-free. The next $1,350 is taxed at the child's rate. Amounts over 2,700 threshold will be taxed at the parent's rate. So, depending on where that money is set at, majority of the time, I think for the parent in the United States, I think the average, matter of fact, why am I guessing? Because the tax, I'll call it like a tax ladder or the tax bucket. Like, let's see, tax rates for 2025. The reason why we got to do tax rates, the tax brackets for 2025 is because they change every year. And especially with the bill that was recently just passed, they call it the Big Beautiful Bill. You have to put that into account. So directly on the IRS Gov website, they talking about it right here. These are the marginal rates for tax year 2025. And so when you go to file your taxes for next year in 2026, you're filing 2025 taxes. This is what it's going to look like. So that first bucket of monies that come out of your paycheck is interesting. Okay. Is getting taxed at 10%. Then anything over this amount gets taxed at 12%. Until it gets up to 22% when you over 48,000. Then anything over 48,000 is taxed at 24,000 up to 24% until you get to $103,350. And then the next bracket is 32,000. 32%. Why I keep saying 32,000? Maybe I'm looking at it like percentages in my head. But 32% for incomes over $197, which means that if you make 100,000, you just got to subtract this amount would get taxed here. Then anything else after that, it's like a whole linear thing. I want to do like a line graph for tax brackets. Let me see if I can find one. Line graph for a tax bracket. Because the reason why I want to show that is to have a visual so everybody can actually understand on what they're seeing and how it's laid out. Not a line graph. Oh my gosh. They literally gotta, I think this will work. This will work. Okay. I went to a website called the taxpolicycenter.org. So they kind of broke it down a little bit. This is just 2016, but this is just a visualization of how the bracket's going to be. So remember it was saying like that first, what are you doing at like 10%? And oh my gosh, this is even worse. I don't like this. It's actually like a waterfall. Like you fill up one bucket, then it goes to the next bucket, and then that's how it goes. Tax bracket 25. There we go. I think I like this one. Yeah, this one's better. Okay, so I found look like another website. So this is from 2022, just to kind of explain for those of you who are listening to the audio. I'm actually at blessingblc.org, and they have a breakdown from 2022. Excuse me, this margarita's hidden. But the way how it's set up, so you can see the breakdown, is that they have the graph here. So they take in the $1,020.50 being taxed at the 10%, plus this amount, plus the max of each amount to get up. So say if it already broke down the taxes for each one, which is great. So the first 1,275 on this graph, you're taxed at, continue reading. You're taxed at 1,000. That's your max tax. And then it just kind of goes on. So then it will tell you if you are at, let's see, what do you stop at? 22%. Okay. Yeah. So it just all evens out to like $12,000 is how much you need to pay. Because they were saying if a single person that makes 75,000 in 2022, how much taxes that they had to pay, and they actually managed to reach up to the third bracket, which is at 22%. The taxes that are owed is 12,000, which is interesting. I guess because the amount that was left over was still under the full threshold. So that is the way how the taxes are broken down. All right, so we got the taxes side of the house taken care of. All right, let's see who's here. Hey, what's going on, gang? Yeah, I'm definitely thinking about doing this instead of the 529 plan. That is interesting. Yes. So now this is two different things. The 529 plan is something that's done by the state, so it's focused on state taxes. This particular program is focused on just the taxes if they were gifted the amount of money into like a brokerage account. So yes, the 529 is a brokerage account, but it's actually at the state level. When you start doing the regular account, which is like you gifting them just money just to gift them, you actually, you know what, you probably can do both, thinking about it. Because if you got two different things to deal with. So the first thing I was talking about, which is the UGMA and the UTMA, far as like those are different brokerage accounts that you can have as a parent for your child. So you can help them invest that way. The 529 plan because that is actually another investment avenue as well for your child, but it's state specific, and then you actually get taxed at state rates. So let's bring up the 529 plan for 2025. And because I'm in the state of Maryland, I'm just going to say for Maryland. Some people say for different states like Nevada, whatever, you don't actually have to invest in the 529 in the same state that you're in. You actually have that ability to invest inside another state if you need to. Now, remember, this is just for educational purposes only. I'm not telling you what to do. I'm just trying to help you educate so you can make the best decision for your family and your lifestyle, and just kind of share all the things that are out there. So it's going to go to what is a 529 plan. And right here, 529 is sponsored by state. So it's going back to what I was saying is that it's state specific. And state agencies and educational institutions, and they are authorized by Section 529 of the Internal Revenue Code. These accounts can be opened by almost anyone. There are no income limits, and anyone can contribute. So this is the beautiful thing about the 529 plans, which I did like that some of my friends did, was actually send me their children's, and even my siblings did it too, was send me their the children's 529 code, and then I can gift $20. And I can actually write that off on my taxes to say, like, hey, I gifted this many children $20 to their 529 plan. Because remember, a gift by definition on the IRS code, let me go down and pull that up because we also need to know what a gift is. What the heck is a gift according to the IRS? So I'm going to go down and share this tab. It's called a gift tax. So for those of you who are listening to the audio, I'm at the irs.gov/businesses/small businesses self-employed/gift tax. Now, I know we talk about self-employed, blah, 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 but we need to also understand like what is considered a gift tax. So a gift tax is a tax on a transfer of property by one individual to another while receiving nothing or less than full value in return. The tax applies whether or not to the donor intends to transfer it to be a gift. The gift applies to transfer. The gift applies to the transfer by gift of any type of property you make. You make a gift if you give property, including money, or the use of income from property without expecting or receive anything less than equal value in return. If you sell something for less than the full value, or if you make an interest-free or reduced interest loan, you may be making a gift. So I want to keep that in mind when you start giving out these gifts to people. Now, we're not talking about from outside a U.S. citizen or anything like that. We just want to talk about gift tax and gift tax purposes at this point. They say right here, if the donor at the time of the gift or the descendant at the date of death was a resident of the U.S., review the instructions on Form 709 for donor or Form 706 for descendant as applicable. So keep that in mind. If somebody passed away and they were giving out gift money to your child, you can actually write this off as a tax-free gift. Now, they also talk about the different forms here, and they have like a nice little T-chart just to kind of explain the difference between the 709 gift tax return versus the 709 NA gift tax return. So you actually can get those returns for that, which is actually pretty cool. All right, so we got that out the way. We understand what a gift tax is. We understood how in the world the gift tax started. But now we are starting to get into the Uniform Transfers to Minors Act, or it's called the UTMA. But before we get there, we need to understand what is the Uniform Gifts to Minors Act, or the UGMA, right? So let's go to learn what the UGMA is. Now, this is a very informative episode of the About That Wallet because we want to make sure that we all informed here, okay? I don't want to do the 529 in case he doesn't go to college. Now, that is a good question. So Bluebird 009, I like the 009. So in case he does not go to college, this was just passed last year. I'm not sure if you remember, because remember, the tax code change every year. This is the reason why you need to pay attention to all of it, because they were saying, a lot of people were saying the exact same thing. Their child was not going to college. What can I do with this 529 plan now that the child does not want to go to college? You can actually roll this over to a self-directed IRA. So actually, I think you can even transfer it to a Roth, if I'm not mistaken. Because that was the thing, that a lot of people were not going for college. So let's go back to the state of Maryland, since I still have the tab up here. So they say right here, not just for college, you have options, right? So for obviously we know the college education and stuff like that. We got the college tuition that the 529 plan can go towards. We got graduate school, right? All graduate programs are eligible as long as they are offered in an accredited private school in the U.S. And certain expenses for special needs students are covered. Gotta take a drink on that one. They got vocational trade school. So even if they don't go to a traditional college, they can even use it for the trade schools if they want to get into plumbing, electrician, construction, HVAC, you name it. They have apprenticeship programs that you can actually use a 529 floor for. Now they also got some tax advantages, but I'm trying to remember. There is one that they talked about for movement of the 529 plan. Let me find that right quick, because I know okay, child did not go to school for 529. Savings. I think you can roll this over. Let me go down and share this tab. Yep. Yeah, that's the tab that I want. Let me see. Hey, what's going on? What's going on, Stay Winning? Yeah, we talked about the 529 plan a while ago, right? And the mega account set your kids up for financial success. Hey, I mean, we didn't get around to the mega account yet, or the MAGA account. I think call it the Trump fund. But that is something that we can discuss a little later. See the IRS tax 529. Because I want to make sure that I get you the right information. Bluebird 009. Because there was something. Okay. Oh, this is old, from 2009. The IRS putting out old information, you guys. It's like, jeez. Contributions, tax deductions. Can you roll? I think you can roll over to 529. Roll over 529 to Roth. To our self-directed. Perfect. Okay, I found a resource. All right. Charles Schwab again. Ha. Okay. So remember, because the money's already taxed majority of the time for the 529 plan, and found it right here. I remember they did it either last year or early this year, but here we go. So right now, for those of you listening to on audio, I'm looking at the schwab.com/learn/story//529-10 -2-Roth-IRA -rollovers -what to no whatever just get to the website. So the actual title of the thing is Roth to mean 529 to Roth IRA rollovers and what to know. Unused 529s can be rolled over into a beneficiary's Roth IRA without tax penalty. But that's probably not the reason to overfund the 529 plans. I mean, yeah, they say that, but whatever. So they say 529s are a tool for helping families save and invest for college, but you also use leftover 529 funds to help save for retirement as well. It works like this. You can roll unused 529 assets up to a lifetime limit of $35,000 into the account. I'm sure they flip this around into the beneficiary's Roth IRA without incurring the usual 10% penalty for non-qualified withdrawals or generating any taxable income. So this is actually very key right here, is that if you put $35,000 in there and just kind of let it ride around and float around, you have up to $35,000 that you can roll over to a Roth IRA. Now, keep in mind, the Roth IRAs are already not taxed because they already been taxed already. So then it can live in that account, accrue all the interest, and you can actually live off the interest, really. So there are ways to get around it, which is actually pretty cool. So yes, so Bluebird 009, yes, it says up to 35,000, but remember, the tax code changes every year. So you need to make sure that you know what the tax code is so you can know the limits. It changes from time to time. So you want to make sure you know your limits on what you can actually take advantage of. So now this is for next year. So keep in mind, you want to keep your eye and ears open for in 2026, what that limit will be, because they actually will change this. Now you can actually, like, I'm on Schwab's website, but you can always go to the IRS as well. They actually have the limits there. But I like Schwab and all these other brokerage accounts because they already look at it and they try to figure out to maximize the way to their accounts as well. Because I mean, they make money too. So they make money by educating you to be successful on that plan. All right. By the way, this episode, I'm actually like really trying to eat dinner at the same time. So I'm having salmon, taking a small break here to eat because I've been eating dinner all day. I haven't had lunch either. So I'm having some kale, some pasta noodles, sun-dried tomatoes, some salmon. It's a Mediterranean salad that they called it. And I put some salmon on top, which is smoked salmon, like with smoked by wood chip salmon. So good. And I got it from Sam's Club. So Sam's Club pre-made salads for the win. I can tell you that right now. And I'm also drinking the blue margarita. I'm sorry, but I need to take a break. All right, and for breaks, I'm gonna go ahead on and do a small trivia so I can get some more bites in. Cause I need to eat. Oh man, they changed some stuff. All right, hold on. So for those of you who got that question right, congratulations. The actual quiz was which state had the highest per capita personal income, and it was Washington, D.C. So congrats to you all who got that right. Let's get back to it, okay? Because it's a lot of information. I want to make sure y'all all are being successful in this program. Okay. Yeah, so Bluebird, you said that if you have 50,000, you'll lose 15,000. Yes and no. So one of the things is that you don't have to transfer that 529 money altogether. So if you use the 35,000, you can keep that 15,000 in there, and you can transfer that 15,000 to the next child. And even if you don't have any more children, you can transfer it to a niece or nephew. So you're not stuck. You can actually change the beneficiary of that 529 plan. So don't feel like you're stuck and the money's just kind of sitting there in limbo. There are ways around it, and so forth. So they even showing here your annual limits for the 529 is $7,000. So, depending on how you want to do it. Now, you actually can revert some of this stuff over. It's like roll some of it over to your Roth IRA. Okay. So they said the beneficiary of 529 must also be the owner of the Roth IRA, and they must have earned income at the equal or the same amount as the rollover. However, the normal income limits for the Roth IRA does not apply for rollover. So even beneficiaries with high incomes can take advantage. So that is something to think about. So you can make do with what you want with it. And when you talk to your tax professional, let them know, hey, what to do with this extra money. Or just say like, hey, I have a UGMA, and no, I have a 529 plan and I have a UGMA, and I want to transfer the money over. When should I do that? How often should I do that? And what is best for my child? So I know we're coming up to the tail end. So one of the things that I do want to share with you all. So I know I'm going through all these different pages and y'all like, man, this is a lot of information, right? So let me show you a little trick that I do for all of my research. This little trick is utilizing AI. And y'all be like, what do you mean by utilizing AI? You can actually put all the websites in there. They can read websites now. I'm here to tell you, yes, they can. So easy. It's already free. You have it built into your Gmail account already. And it's called Notebook LM. So this is like the second portion of the show where I like to talk about AI tools and how it can help you build and strengthen your understanding or cut the curve down on your research. So let me share my tab here. So all I did was just type in Notebook LM and say create new notebook, and it brings me up to this lovely screen. On the screen, for those of you who are listening to audio, it actually just type in Notebook LM when you get a chance to get in the car. I mean, if you're in the car right now, when you get home, you can do this. Let's go to Notebook LM. Just say, yeah, you want to create your account. You want to start your notebook, start a notebook. It brings you up to this lovely screen where it has the sources, the chat, and the studio. All right. So the first thing you want to do to start off with this program is that you want to click on upload a source. When it shows up to upload a source, another window will show up and it says add sources. Sources let Notebook LM base its responses on the information that matters most to you. For example, making plans, course reading, research notes, meetings, transcripts, sales, documents, etc. So right here it says you can upload things from like your Google Drive account. You got your Google Slides if you got them. Link, you got your websites, you got YouTube, or even paste text. So for me, I don't like to copy and paste a lot. So I can actually I clicked on website URLs. So they say paste the URLs below and upload them as sources. To add multiple URLs, separate them with a space or a new line. Now, because we've been bouncing around from the IRS website talking about tax inflation for the tax year, right? Do we really care about that? No, not really. Because we're talking about the UGMAs and the UTMAs. So we talked about the 529s. We're not going to worry about that because our focus is on the UTMAs today. I know we went off the rails a little bit, but let me go ahead on and just kind of ramble off what a UGMA is. I'm going to share the screen. So a UGMA is a Uniform Gifts to Minors Act. The Uniform Gifts to Minors Act allows money and financial securities to be transferred to minors through the UGMA account and is allowed in all states. The UGMA allows the property to be gifted to the minor without establishing a formal trust. Because a lot of times people keep saying, well, you need to build trust to transfer the money and blah, blah, blah. No, you don't need to do that in this particular case. The donor or the custodian manages the property of the minor's benefit until the minor reaches of a certain age, which we just found out through the IRS website is up until age 19. Once the child reaches a specific age set by the state, the child will have full control over the property. Gifts to the minor are exempt up to $15,000 a year from federal taxes. Now, keep in mind, this information is from 2021. So the numbers here are going to be a little different. So by the time you're ready to start a UGMA for your child, you want to double check on the tax code on how much money. But again, remember we were looking at what one of the writers or listeners had written in to the show to kind of discuss, hey, I got $10,000 that was gifted. I don't know what to do with it. They can actually create a UGMA. Well, part of the UGMA, we have another thing. We'll talk about it, which is the UTMA account for federal taxes, but the minor will be required to pay taxes beyond this amount. Also, UGMA transfer allows the gift to be taxed based on the minor's tax rate. The downside to the UGMA is that it can reduce or make the minor ineligible for financial aid. Since this property is owned by the minor, the UGMA is to be contrasted with newer Uniform Tax to Minors Act, or the UTMA, accounts that allow more risky assets, intangible assets such as real estate, to be transferred to the minor as well. So let's go on over to the UTMA and let's figure out more about this one. Okay, so the UTMA, well, let's go back. I want to go back to this one because I want to copy this particular link and I want to add this to our notebook. And they said that we can do a comma, mean just separate it to a new line. And then we're going to read through what the UTMA is, and then we'll add that over too. So the Uniform Transfers to Minors Act expanded on the UGMA, which is the Uniform Gifts to Minors Act, allowing all kinds of property, such as bonds, real estate, and art, to be transferred to minors that was adopted by most states. The UTMA allows the property to be gifted to the minor without establishing a formal trust. So it seems like it inherited some of that parent information. It seemed like the donor or a custodian manages the property for the minor's benefit until the minor reaches a certain age. So again, we hear that same language. Once the child reaches a specific age set by the state, the child will have full control over the property. Gifts to the minor are exempt up to $15,000 for a year from federal taxes, but the minor will be required to pay taxes beyond this amount. Also, UTMA transfer allows the gift to be mean to be taxed based on the minor's tax rate. The downside to the UTMA is that it can reduce or make a minor ineligible for financial aid since the property is owned by a minor. So I want you to keep that in mind as well. All right. So we got the UTMA, we got the UGMA. Oh man, I thought I was sharing another screen. My bad. Sorry, guys. Yeah, I was actually sharing this tab. I was reading off this tab, but you get it. And this actually coming from Cornell Law School. So just understanding what the acts are that are available. So also, Cornell mentioned something from the secure.ssa.gov website regarding the Uniform Transfers to Minors Act, and it was actually talking about how it was developed and talking about the definitions of what is a donor, what is a custodian, what is a minor, an individual who has not yet attained the legal age of majority as established by law. So this is more of the lawyer speak side of the house of everything from the SSA side of the house. So if you really excited about diving into all of that, you can, and it'll be nice if I was actually sharing my screen. So there you go. I didn't realize I wasn't sharing my screen this whole time. I get this right one day. It's just so many screens opening up, and I just want to make sure that you all have this info. Okay, so we got the UTMA listed there, and we're going to add this to our notebook. All right. Then also we got, also we want to add, we want to add this particular site here too, which is IRS, talking about Form 8814, which is the parents elect to report the child's interest and dividends. So if you, for any reason, are receiving dividends for the investments that your child is getting, this is where you can do it. Now, there is something to think about too. Again, this is for educational purposes. You have the ability to do something which is called a DRIP, which is a dividend reinvestment plan or program. And what that does is allow for every time you get a dividend, it automatically reinvests into the account. So it's not considered income. So I would suggest to look into that for your plan. Is that something that you plan on doing? Unless you want to have your child get some income, that's also another option. So let's go ahead on and add that to our notebook as well. Share that to our tab. We're going to add that one because we need to know about it, right? What else do we want to add in there? We can add in the Schwab custodial account, one that we read earlier in the first half of the show. So let's go on and add that one. And then we want to add, I think that's about it. Oh, and I found one that was actually pretty cool. I didn't talk about it earlier, but this one is called the earlybird.io. I mean, getearlybird.io, which is confused about the UTMA tax rules. Here's the breakdown. And then you get like a little breakdown. This looks like a 5-minute podcast episode, but let's see. Before they come to us, get the gifts. We already know that. We already know what the UTMA is. We already know what the UTMA versus UGMA. So we already talked about that. The major difference is that the UTMA they'll get like artwork and financial assets already. How the UTMA is taxed. They say it's sometimes difficult to understand. The UTMA accounts may be subject to tax to minors. Yeah, we know that already because we read the tax code. See, this is what happens when you read the tax code for yourself. When people try to put things up there, it's like, we know that, and we at least know that they're not lying. And if they are providing anything new, is it true? And this is one of the things that's weird because I like that they put here, they say first as of 2023, because they know the tax code changes every year. And this is the thing that we have to keep in mind when we read some of these documents. And this is one of the reasons why I try to make my show evergreen by sharing things that you can go back to. I'm like, okay, Anthony did talk about this, but this was 2025 numbers. Okay. Or last year we talked about it. I was like, hey, these are 2024 numbers. in 2023 numbers in 2022. It's I've been doing this since 2021, start talking about taxes. So keep this in mind, that it seems like they're not providing anything additional that we don't already know, and we already have the latest information. So we're not going to add that particular link. Now let's go back to our notebook LM. And then since we got our 1, 2, 3, 4, 5 sources, we're going to hit insert. So right now it added everything in here, and it already gives us a summary based on all 5 sources. They say these sources primarily discuss the UGMA and the UTMA, which are the legal frameworks allowing adults to transfer assets to minors without needing a formal trust. They detail how these acts of custodian minors benefit and so forth, and also outlined in the Form 8814. Additionally, the sources highlighted the potential impact of these accounts on minors' financial eligibilities due to asset considerations. Now, I do like mine in dark mode, so let me see if I can change this to light mode so it makes it easier on the eyes for everybody else. Okay, the reason why I like Notebook LM is because you have something here in the lower right-hand corner called Notes. You have the FAQ. So I just clicked on FAQ. It's actually generating an FAQ, like frequently asked questions, based on the 5 sources. Then I'm also going to click on a study guide. Oh man, I forgot to add the document with the thing. Yeah, this thing, the PDF. I forgot to add that one. Now, because there was a source I actually forgot to add, I can go over here, back to sources, click add, go back to website, add in that particular PDF, and boom, it's there. So what I can do is, because I already generated the FAQ pages and the study guide, I'm going to delete those because I want the latest information that I just added. And then I'm going to regenerate the FAQ, and I'm going to regenerate the study guide. Now, the cool thing about it is that, say if you're tired of reading, you got your sources, and you just want to listen to it all, you can do a deep dive episode, which I call a deep dive episode, but you can do shorter, right? So I'm going to do a shorter length. And I'm going to say, focus on a parent looking to learn about UTMA and UGMA. I think it's called, we just said the UTMA, UGMA. Make sure I get the right terminologies. The UTMA and the UGMA. Yep. For the first time. And want to know the limits, the donation limits. Okay, and then I can just click generate. Since I did shorter, so it can take a short time to do that. So while it's running in the background, I'm gonna go ahead on and take a look at the notes for the this one is called the gift taxation. So they're talking about, this is just like a study guide, almost like a FAQ. I'm sorry, this is the FAQ page where they're talking about, you know, the types of assets that are commonly used for gifts. Can married couples split gifts for tax purposes? How do you UGMA? Like, this is a great FAQ to get started. And if you guys want, please let me know in the chat to say, yes, I want this. I can put this as a blog post on my website, so you have access to all of this information. And they even talk about the key characteristics of a UGMA versus UTMA accounts. And then they talk about the types of assets that you can transfer, the taxation for the custodial accounts. It's already broken down to nice, easy to read for understanding purposes. And already it's done. And then they even give you a nice little quiz at the end, you know, as far as like how to explain it. And then they give you the answers. And then it gives you essay format questions. So if you just want to do this for practice, and even glossary terms on what it is that was discussed in the notes that was already provided. So when it comes to understanding any topic, there is no reason why you can't use AI to kind of help you get around all of this and actually make sense of what it is that you're looking at. So it's 9 o'clock. And I know we've been chatting for a while, but I want to make sure that everybody has the information that's necessary to be successful with their financial uh, ideas. And because remember, we say we want to make sure that you're competent, which is that you have to do your research. And this is the type of research when you do deep dives, when you listen to other podcasters are saying, like, hey, I got to do my research for the episode. If they doing their research to try to tighten this up a little shorter, like I took almost a whole hour hopping around between different things, talking about the 529 plan. This is what I'm talking about. So Google had already just finished creating a mini podcast episode just on this. And I'm going to play this clip and that will conclude the show. If you are first time here, I want you to go ahead on and like, subscribe, and go ahead on and share this episode out to somebody who could benefit from this and really take a deep dive into this particular topic. So let's go ahead on and get to it and let's see what they got to say.
Okay, let's unpack this. As a parent, you naturally want to set your children up for success, right? And for many of us, that means thinking about their financial future, getting things started early. Today, we're doing a deep dive into 2 tools for gifting to minors: UGMA, the Uniform Gifts to Minors Act, and UTMA, the Uniform Transfers to Minors Act. We really want to make sense of these, especially for you if you're a parent just starting to look into this, wondering about the rules, the donation limits.
Exactly. And what's really interesting, I think, is how these acts give you a structured way to give, building wealth for your kids, but also dealing with things like taxes and, well, who controls the money? So today, we'll look at what they are, the differences, and really focus on those contribution limits, what they mean for you. So first off, UGMA, that came about back in 1956, and then UTMA, which was finalized around 1986. They're what lawyers call model laws. Think of them like templates. States adopt them to let people, like you, give gifts to kids without needing a complex, often expensive, formal trust.
Okay, model laws. So they sound similar. Uniform gifts, uniform transfers. Are they basically the same thing now, or is there a key difference parents need to know?
That's a really good question. And there is a big difference. UGMA, the older one, was pretty limited. It was mainly set up for gifts of like cash or securities, stocks, bonds, that sort of thing.
Yeah.
But UTMA, it really opened things up. Under UTMA, you can gift almost any kind of property. We're talking real estate, intellectual property, art collections, pretty much anything of value.
Wow. Okay. So much broader.
Much broader. And that flexibility is why almost every state jumped on board with UTMA. They basically rolled UGMA into it. There are just a couple exceptions. South Carolina and Vermont, they haven't officially adopted UTMA, so folks there are generally still working under the older, narrower UGMA rules.
Mhm.
Now, something really crucial to understand. When you make a transfer using UGMA or UTMA, that gift is irrevocable.
Irrevocable. So no turning back.
Exactly. It's not just a technical point. It's a real commitment. Once you gift that asset, it legally belongs to the minor, and it's out of your direct control. An adult, called the custodian, manages it for the child's benefit. They look after it until the child hits the age of majority.
And that age is
It varies, depends on the state. Usually it's 18 or 21. Sometimes it can be pushed out a bit, maybe to 25 in certain situations. But at that specific age, whatever it is in that state, the child gets full, unrestricted control of everything in the account automatically. And before that age, any money spent has to be strictly for the minor's benefit, not for general family expenses, but for the child.
okay. Got it. So irrevocable gift managed by a custodian. Child gets it at 18 or 21. So the big question then, especially if you're thinking about contributing regularly, how much can you actually put in each year without, tax headaches? Let's talk limits.
Right. This is key for planning. For the tax year 2025, the federal gift tax exclusion amount is $19,000 per beneficiary. That means you can give up to $19,000 to one child in one of these accounts in 2025, and you don't generally have to worry about federal gift tax.
19,000 per child. Okay. What about if you're married?
Good point. For married couples, there's something called gift splitting. If you both agree, you can essentially combine your individual $19,000 exclusions for the same child. So together, you could potentially gift up to $38,000 per child in 2025 into their custodial account, again, without triggering that federal gift tax.
38,000. That's quite
Wow.
significant. So this is all tied into the gift tax rules then.
Precisely. The whole idea behind the annual gift tax exclusion is to let people make reasonable gifts without needing to file gift tax returns or dip into their lifetime estate tax exemption.
Yeah.
These UGMA, UTMA contributions fall right under that rule. Understanding that link helps you use these accounts strategically.
Makes sense. So you make the gift, it goes into the account. What happens when the investments in the account start earning income? Dividends, interest, capital gains? How does the IRS treat that? I've heard about the kiddie tax. Is that something parents need to watch out for?
Yes, definitely. The kiddie tax is something you absolutely need to be aware of. It's designed basically to stop parents from shifting large amounts of investment income to their kids just to pay tax at the kids' lower rates. So for tax year 2025, here's how it breaks down. The first $1,350 of the child's unearned income, like from this account, is completely tax-free, zero tax.
Okay, $1,350 tax free.
Nice. Then the next $13,350 is taxed, but it's taxed at the child's own tax rate, which is usually quite low. But here's the catch. Any unearned income over that total, so over $2,700 for 2025, gets taxed at the parent's higher tax rate.
Ah, okay. So it sort of snaps back to the parents' rate after a certain point.
Exactly. So while there's a benefit on the first chunk of earnings, significant income gets taxed as if you, the parent, had earned it. It limits the tax saving potential on larger account balances. Oh, and one more thing to make filing easier. Parents can choose to report their child's interest and dividends directly on their own tax return. There's a specific form for that. IRS Form 8814. Saves the child having to file their own return sometimes.
Right. Form 8814. Good to know. So, beyond the taxes each year, are there other, maybe bigger picture things parents should consider? Like, how does having this account affect things down the road? College, maybe.
Yes, college financial aid is a really, really important consideration. This is probably one of the biggest strategic points because the assets in an UGMA or UTMA account legally belong to the child. They're counted as the child's asset when you fill out financial aid forms like the FSS.
That's not good for aid eligibility.
Generally, no. Financial aid calculations weigh student assets much more heavily than parental assets. Often, something like 20% of the child's assets are expected to be used for college costs each year. Compare that to parental assets, which are assessed at a much lower rate, around 5.6%, or sometimes not at all, depending on income. So, a large UGMA or UTMA account can significantly reduce the amount of need based financial aid a student might otherwise qualify for.
Oh, okay. So, building this nice nest egg could actually backfire a bit when it comes time to pay for college if you're counting on aid.
It's definitely a trade off to consider. You're saving and investing for them, which is great, but it might impact aid eligibility later. It's different from, say, a 529 plan where the money is generally treated more favorably as a parental asset in aid formulas.
Right. Okay. So bringing it all together, we've got UGMA and UTMA ways to gift assets irrevocably to kids. UTMA is broader, covers more property types. There are annual contribution limits for 2025, $19,000 per person, or $38,000 for a couple splitting gifts to avoid gift tax. And the earnings face the kiddie tax rules.
And that crucial point about financial aid impact. So, the big takeaway question for you as a parent thinking about this is really about balance, isn't it? You're making this irrevocable gift, starting well for your child, which is fantastic. But how do you weigh that immediate benefit against potential long term impacts, like them getting full control at 18 or 21, or, as we just discussed, the effect on potential college aid? It's not just about the numbers, it's about the bigger picture for your child's future. Definitely something worth mulling over.
All right. So, one of the things that I have to say about this is that, for one, it's a great opportunity right now to start thinking about how you can move forward with your finances. This is just another avenue to kind of help you and your child bring in some extra income and or invest inside your child's future. So we talked about the 529 plan. We talked about the UTMA and the UGMA and how that can take advantage of you, how you can take advantage for that. So because of we did this as a live show, I'm gonna go ahead on and take that audio, slap it on over to the podcast side of the house, so people can actually learn a little bit more about it from the research that was provided. So I am going to call it a night. And as always, remember to wash your dishes after you finish using them. Your past me, your future self will thank your past self. All right, everybody. We out. Peace. Hold up, I ain't got my outro video. This is what happens when they change your stuff, man. All right. Let's see if we got this. All right, we out here. Hold up. We got more people joining. Did y'all just join? I'm listening, looking at, like, I see a couple people just join on YouTube because I was about to shut it down. That's y'all nay. Y'all got any questions? Yeah, you nay? All righty. Be out of here, folks. All right. Peace.